You want to know what the top 8 weekly ETF funds are? We researched them. The ones that we show with no NAV erosion in the data we reviewed and had strong distribution numbers. Today we're walking you through each one of them for an educational perspective so you can see how the data stacks up. Welcome back to the channel. I'm Doug, the Retirement Guy, and today we're reviewing our educational breakdown of 8 weekly ETFs based on the information available at the time of the recording. Let's dive into today's video. How do we select the ETFs? Here's the framework we use for our research. The NAV stability. We looked at ETFs that showed no NAV erosion in the period reviewed. The positive total return year to date. The distributions track record. Weekly distribution histories were available. Total return over 15% year to date based on the data we had and the potential for growth. Strategic entry considerations, understanding that leverage option ETFs can behave differently. These simple criteria used for today's review and not recommendations is what we have. We have to say the disclaimer, this presentation is for educational and informational purposes only, based on the analysis of the current publicly available information. It does not constitute financial or investment advice, and investment decisions should always be made based on your own research. Always consult a qualified licensed financial professional before investing. So understanding NAV, I want to make sure people understand this. NAV erosion, also known as NAV decay, is when an ETF share price declines over time, especially if distributions exceed earnings. A fund with no NAV erosion during the review period that we used maintains or grows its share price relative to the launch. Why does this really matter? Well, it helps protect long-term principal. It supports sustainable of the distributions. It helps maintain the purchasing power and gives you a clear picture of a total return potential. This is why we evaluate total return and not just yields. So let's look at exactly what our first fund is, and that is going to be from the Roundhill Weekly Pay, HOOW, the Robinhood Weekly Pay structure. Now, the underlying stock of this is Robinhood. The distribution rate is around 51% year to date. The growth is 11.53% year to date, and the total return totals out to be 62.61% year to date. This has constantly appeared strong in our analysis and remains one that we continue to monitor closely. Our number 2 fund still comes from Roundhill, and that is going to be the Google Weekly Pay, the GOOW. The Roundhill Google Weekly Pay has a distribution rate of 15.72%. Now, this one launched in July 24, 2025, and has had a growth of over 43.94%. giving it a total return of 59.66% year to date. A newer fund, but the early growth data has been noticeable. Our next fund is going to be from the Rec Shares Growth and Income NVIDIA, NVII. Now, their unique 50-50 strategy, if you're not familiar with Rec Shares, they use a 50% of the fund as growth, uncapped, allow it to do what it needs to do. And then it does a 50% option call income, selling those call strategies. So that 50% growth that's uncapped uses a 1.2% leveraged increase. The distributions are 23.28%, a growth of 14.51% for a total return of 37.79%. The blended approach appears to be functioning as intended in the 2025 data. Number 4, Rec Shares Growth and Income Tesla. So all we're doing is changing the underlying stock, which is Tesla versus NVIDIA, Same exact process, that unique 50-50 strategy. Their distributions came in at 25.06. Their growth, 4.84% for a total return of 29.75. So that similar structure to NVIDIA, but with that Tesla underlying asset, has given some quality numbers. Now, number five fund comes out of the YieldMax package. This is the YieldMax Semiconductor Portfolio, CHPY. Distributions are 24.20%, the growth of 18.36%, and a total return of 42.56%. What stands out is a diversified semiconductor basket from Broadcom, NVIDIA, Micron, and Lab Research. More balanced than many single stock YieldMax ETFs or Roundhill ETFs. Now we go back to Roundhill, the weekly pay gold miners, GDXW. Newer, but still interesting data. Now the distribution is 3.35 year to date so far. But projected distributions, according to Roundhill's published materials, is going 38.27%. They've already had a growth of 15.42% year to date, and the total return is 18.77%. Now, when you look at this fund, is very new. It came out in November of 2025. But because of its early performance, we included it in the review. Number 7, Roundhill's Magnificent 7 Covered Call, MAGY. Distributions 20.38%. Growth 2.64%. And a total return of 23.02%. One of the more consistent weekly pay ETFs in terms of distribution smoothness. The year-to-date return, with the last market correction of November, we have still maintained a positive year-to-date. And coming at number 8, the Nicholas Crypto Income ETF, BLOX, BLOX. Now, this is not direct crypto. This is focused on crypto-related companies, almost like the entire market of crypto. The iShares ETFs, the mining companies, the chip makers, everyone is all part of BLOX. The distributions are 17.96%. Now, the growth has a negative 0.77%, mostly from the market correction that we've had here in November. So a total return of 17.19%. But that recent volatility in crypto affected the short-term performance, but the total still seems very positive. So why does total returns really matter? Why do we want to know about total returns? Well, that is your distributions plus your price growth. And the key insights from our analysis is HOOW led the group with the highest total return in the reviewed period. GOOW showed exceptional growth, and NVII offered that strong balance between growth and income. Now, CHPY is a standout semiconductor-based income approach. So we next look at the performance comparisons. Look at the growth. GOOW gives you that growth, while HOOW gives you the income, and NVII gives you a balanced approach. Now, this is just from the data that we had, but you can see how everything stacks up. The conclusion. Here are the key takeaways from today's data from the review. Maintaining or growing NAV is just as important as yield. The RecShares 50-50 strategy shows meaningful downside management during the volatility periods. CHPY stands out as one of the most balanced weekly paying option funds. And entering the timing market, especially with leverage or option-based ETFs, is critical. BLOX provides crypto industry exposure without direct crypto holdings. Again, none of these investments is advice. It is simply to show how the data stacked up based on our research window. Let me know your comments of what you think. Do any of these ETFs stand out from your own research? Let me know if you're invested in any of these. I would love to hear from you. Don't be afraid to put it down in the comments below, and we'd love to see you back.
Thank you for watching. Press the like